In the world of investing, everything starts with the balance between risk and return. Just as a market can double in value rapidly, it can also drop by half just as quickly. A stock that rises by 100% can just as easily fall to 0% or even declare bankruptcy. So, what does this mean? Whether it's stocks, bonds, real estate, or any other asset, they all share one common element: risk. If you believe that choosing stocks or funds that performed well in the past will always yield profits, you might be mistaken. This is one of the biggest misconceptions in investing. This raises an important question. Is the success of portfolio managers truly based on skill, or is it purely a matter of luck? In reality, the biggest risk is failing to diversify your portfolio properly. What matters isn't just what assets you hold, but how those assets move together. This is where portfolio theory comes into play. Intelligently combining different asset classes is the most critical aspect of investing. Finance is a social science. Unlike physics or engineering, where a bridge or circuit always behaves the same way under given conditions, finance does not follow such concrete rules. Systems that seem similar can behave entirely differently over time. Right now, we're going through a tough time in the investment world. Markets resemble a minefield, ready to explode at any moment. Both amateur and professional investors face disappointment due to the uncertainty. Do these fluctuations present golden opportunities or warning signs? Finding our way through this chaos is not easy. At this point, it might be a good idea to take a look at William Bernstein's book, The 4 Pillars of Investing. Bernstein acknowledges unpredictable movements in the market while emphasizing the importance of building a solid strategy based on historical lessons. Could achieving investment success be simpler than we think? How can we avoid the pitfalls of the past? What are the long-term strategies that yield consistent results? Let's explore these questions through 4 fundamental pillars: theory, history, psychology, and practical application. Higher returns generally come with higher risk, one of the fundamental laws of investing. But the key isn't just taking risks, it's taking the right risks strategically. In simple terms, risk is the probability of losing money. One of the most important messages in the book is that even the world's most knowledgeable economists can sometimes make this mistake. They confuse expected returns with actual returns. In other words, they mix up the future with the past. Bernstein frequently highlights a critical point. Past high returns often indicate that future returns will be lower, and past low returns often suggest that future returns could be higher. The biggest challenge here is that buying assets when prices are low always feels terrifying. The very disasters and risks that cause low prices also set the stage for the highest potential returns. The stock market crash of 2020 is a perfect example. Many investors, both amateur and professional, suffered losses during that period, while those who diversified their risk were able to recover more strongly in the rebound. This provides a crucial lesson, not just about market volatility, but also about how investment strategies play out over the long term. Many investors try to predict the performance of stocks and funds. They follow hedge funds or stock market experts, believing they can gain an edge. However, research shows that the differences in fund managers' performances are mostly due to luck rather than skill. Stock returns are almost entirely random and impossible to predict. Last year's returns or even the past 5 years' performance tell you nothing about what will happen next year. This is what's known as a random walk. No one, not the most experienced analysts at major investment firms, not financial newsletter writers, can predict where the market will be tomorrow or next year. Most mutual funds that perform well in one year fail to maintain that performance in the following years. As Warren Buffett has emphasized, a well-diversified, low-cost index fund often outperforms even professional investors over the long run. In investing, the greatest risk is failing to diversify properly. Diversification is simply another way of saying, don't put all your eggs in one basket. Holding a mix of asset classes, stocks, bonds, real estate, commodities, and so on, is one of the most effective ways to minimize risk. For example, if you invest all your money in tech stocks and the tech sector experiences a downturn, you could face significant losses. However, if your portfolio also includes holdings in agriculture, healthcare, and energy, losses in one sector may be balanced out by gains in another. Investors often focus too much on the specific assets in their portfolio. But what really matters is how the portfolio behaves as a whole. Each asset in your portfolio might seem attractive on its own, but the way they interact determines your overall returns. This is the essence of portfolio theory, a concept in finance that doesn't just focus on individual asset returns, but also on how those assets perform together. By combining low-risk and high-risk assets, the overall portfolio becomes more balanced and delivers more stable long-term returns. By blending safer investments with riskier stocks, you can mitigate volatility and increase overall returns. To sum up this section, if you don't take on risk, you can't expect high returns. But if you want high returns, you need to set aside the expectation of guarantees. The best investment opportunities often arise when things look the worst. The longer you hold risky assets, the lower your chances of losing money. A stock or bond is valuable only for the future income it will generate. In the short term, asset prices are influenced almost entirely by speculation and are unpredictable. Future returns should be considered only from a long-term perspective. Even the most aggressive investors shouldn't allocate more than the 18% of their savings to stocks. There is almost no evidence that professional fund managers are particularly skilled at stock selection. Over time, their performance is nearly indistinguishable from random chance. There is also no proof that anyone can consistently time the market. The best way to secure reasonable returns is through index investing. Past portfolio performance has little predictive power over future portfolio behavior. Instead of chasing past winners, focus on maintaining a well-diversified and cost-effective portfolio. Every generation experiences market booms and crashes. Investors often suffer heavy losses, and some even go bankrupt. Even those who prepare well sometimes fail. The book argues that a lack of historical knowledge is the single biggest cause of investment losses. Even if you master theory, psychology, and investment strategies, you must stay rational when everyone around you is losing their minds. Nothing shakes a person's confidence like watching a friend get rich while they remain stagnant. Market bubbles form when investors buy stocks just because they're rising. This creates a self-reinforcing cycle until the fuel runs out and the bubble collapses. At the same time, just as rational investors must resist irrational enthusiasm, they must also resist widespread pessimism. When everyone is avoiding an investment, that's often the best time to buy. The book argues that the rise and fall of markets will never stop because finance is driven by human behavior. Investors will always be influenced by their emotions and ingrained psychological tendencies. Periods of excessive optimism usually lead to the lowest future returns, while periods of extreme pessimism often lead to the highest future returns.